Hey, Dan Fitzpatrick here, stockmarketmentor.com, and I want to give you just a quick look at AEM, Agnico Eagle Mines. This is a stock that we traded in live trading on Thursday morning, and I just kind of want to walk you through this trade. If you look at this on really wide Bollinger Bands, 3 standard deviations are the red ones. It's kind of like a law of nature that stock prices are not supposed to go outside 3 standard deviations. It's like the chances of them doing that are probably about as great as the chances of Donald Trump going a day without being on Twitter. It's just very, very minuscule. Anyway, so that's what happened with AEM last week. And the thing is, when you see this kind of bounce, you really start expecting it to go the other way. Just because when a stock is so weak, selling is so strong to the downside, you've got to expect some kind of a snapback. You know, not every stock that's down like this goes to zero. So the lesson, though, is don't just, if it doesn't run up the first day, here it closed at the low of the day, even way lower than it opened, and it opened really badly. Don't just give up on the stock. We don't. Very next day, it still kept going. Now, here's the thing, though. You don't buy it here and then hold like an idiot as the stock moves lower. That's not your trade. The only reason you're going to buy a stock like this is if you think it's going higher. So if it doesn't go higher, who's the idiot? The stock or you? The stock's going to do what it wants to do. That's it. And so if you're buying the stock in anticipation of a run up and it doesn't, it doesn't help you out, that's about as dumb as shorting stamps.com the other day because it was up so much. You figured that you'll short it because it's going to go down. And it ultimately will go down, but from a level that's much, much higher than the level that you shorted it at. So again, who's the idiot, you or the stock? Point is, you don't just buy a stock because it's down. You buy a stock because you have a plan and an expectation for what that stock's going to do. And if it does it, then great. It shouldn't be a surprise to you. It shouldn't actually even be pleasant or thrilling. It should just be doing what you expect it to do. The easy move is when the stock doesn't do what you expect it to do, when it does something else, then that's pretty easy. You just close the trade. So anyway, looking at this stock, right? So this is where it traded on Tuesday. And then Wednesday, this is what I had described as the turnaround day, really, because the low was even lower, but the stock closed green on the day. It closed up relative to the prior day's close, albeit only pennies. But so we come into Thursday, and my expectation is we're probably going to see a move back up. And so we jumped on this thing first thing in the morning, and that's exactly what happened. But here's the lesson, I guess. The stock closed at 51.39. And during the day, we got into it closer, around $50. It might have even been a little lower than that. I forget, and it doesn't matter because we can't make that trade on Monday. But we got into it at a pretty good level, and I had described this as not being a day trade. I said, I think this stock can go higher, probably to 52. But you probably have to hold on to it for a few days. Well, turns out on this particular day, it almost made it there, but a lot of people were still holding the stock, and so now we come to today. The stock gaps up above 52. A lot of our traders sold their shares for a pretty nice gain, 2-day gain. You're not going to get rich off of this type thing, but if you learn to do this consistently, let's just say you're not going to go broke either. So this is a trade that, again, we put on expecting a multiple day hold, expecting that. And then with all the coronavirus stuff, isn't it interesting how the Chinese are always telling us that, it's all going away, no big deal. And then turns out that they defined it as, you only have coronavirus if you die with bleeding eyeballs and white foam coming out of your mouth. Oh, look, the number went down. Anyway, so nobody's buying that bullspit. And that's one of the reasons why we're getting gold going up so much. So I think that's going to continue to move. But I will say I think this move in Agnico Eagle is over. We got it really good here. And we sold it right at the open. Anybody who was trading along with Dan, right at the open at 52.85. So that was a pretty nice trade. Anyway, that's all I got on this. But you can do these types of trades all the time if you key off of these 3 standard deviation bands. Stocks that go way below are infinitely buyable, just like stocks that go way above are infinitely shortable. Hence, though, why I talk about stamps. If you look to short the stock the other day when it gapped up so much, it gapped up really high, ultimately ran way above the upper Bollinger Band, 3 standard deviations. But the point is, you can short this stock, and we actually looked at it same day as Agnico Eagle. We looked at it but passed. And the reason was because the stock wasn't going down. The stock was really strong. And in fact, a lot of people actually got long the stock, even though the stock was outside 3 standard deviations. So anyway, the bottom line is, yeah, this is a good trade on stamps or on Agnico Eagle, but it's more like a good trade on this strategy of looking outside these stretched out bands. So anyway, hopefully that will help you in your own trading. Members, over to the strategy session in this weekend update.